Good morning, everyone. I'm Ann Sheehan. I'm the Director of Corporate Governance for CalSTRS, the State Teachers Retirement System here in California. And it is a pleasure for me to moderate this panel. I would say I'm amongst friends up here. So I know you have their bios, but let me briefly go through and introduce the panel before we get started. On the far side, we have Ed Garden from Trian, Cliff Robbins from Blue Harbour, Michelle Edkins with BlackRock, the head of corporate governance for BlackRock. We have Barry Rosenstein from JANA Partners, and closest to me we have Peter Weinberg from Perella Weinberg. So, activist investing, it has really, as I read recently, as someone said, it is the reality TV of the investment world with all the personalities up here. But I think today we have some of the kinder, gentler activists with us today. So why don't I get started? Ed, why don't you kick off? Tell us about your strategy and why you're involved in activism and why it's good for the markets.
All right, Ann. Well, first thing I would say is I'd make the observation that there's a bit of a disconnect between the stereotype of an activist investor and what reality is. So think about the stereotype, combative, looking to vilify management in the press, very short-term oriented. And I think that's very different than the reality. There's still some of that, but for the most part, that animal is out of business. And the activists that are left, including my fellow panelists, tend to be very institutionalized, have a lot of capital at their disposal, have very blue chip LPs, have a real infrastructure, have a track record of adding value, a track record of having success in the investments, have very strong relationships with the other institutional investors. So I think there's a real disconnect between that stereotype and what reality is. With regard to Trian, our place in the world is to invest in what we think are fundamentally world-class companies, but where management's struggling. And struggling typically means having a hard time really getting the business growing and growing profitability, and where we have a plan on how to get the business turned around. Our core competency is operations. It's making businesses materially more profitable. It's a turnaround expertise at our firm that goes back for decades, and many of you know my partners, Nelson Peltz and Peter May, have a 3-decade long track record of successfully turning around businesses, whether it's American National Can in the 80s or Snapple in the 90s, or more recently Heinz, Tiffany, Family Dollar, Ingersoll Rand, Cadbury. Our place in the world is presenting management and the board with a thoughtful, realistic, quantifiable plan on how to get the business going in the right direction, how to make it more profitable. We look to work constructively with management and the board to do that. And we're very income statement operationally focused. And just to close that up, one example is Heinz, where obviously the company's being bought right now by the Brazilians and Warren Buffett. But when we invested in Heinz, world-class business, but earnings had gone down for a decade. And so the challenge for us was, what can we do operationally to really get this business going in the right direction? A lot of people felt that the business was in secular decline, that private label had forever changed their fortunes. But it was our point of view that the company needed to spend more money on its brands, more money on packaging, on new products, on consumer marketing. They had gotten twisted up where they had cut that spend in order to make quarterly numbers. And as a result, we're spending $2 billion on deals and allowances, which is basically competing on price with retailers. So our whole plan, just to distill it down, was to take that money back from retailers and redeploy that capital into the brands, new marketing, new packaging, new products. The reason that was controversial was because when you take money away from retailers, volumes are going down. So in the short term, that was going to be tumultuous for the company, and earnings were probably going to go down even more, which is why management, was afraid to do that. But we really gave them cover with investors, with the board, to go down that path, and obviously it had a great outcome.
Yeah. And I'm going to come back to Heinz because that was a fight. It wasn't a quiet engagement. Hey, Cliff, tell us a little bit about your strategy.
So I started Blue Harbor in 2004 after 20 years at KKR and General Atlantic. And what I realized was the best deals I'd been involved with really had nothing to do with the leverage. It had to do with backing the right management teams that could create value. And as I thought about it, I realized that whenever a strategic buyer or a private equity fund would buy a company, they'd pay a 30 to 50% premium, and then they'd have 3 or 4 things that they wanted to do to unlock the value. In every deal it was different, but maybe we wanted them to sell a division that didn't fit, or make an acquisition in a consolidating line, or refinance the real estate, or securitize IP, whatever. And I've realized that if I could go to the same company while it was public with the same list, here is the list for your company, here are the 3 or 4 things for your company to unlock value, and I could avoid paying the 30 to 50% premium and be a lead stockholder in the public markets, you know, we would do well. You know, in the investment business, would you pay for something such a prime determinant of your return? If you could avoid the 30 to 50% premium by identifying those companies that are going to unlock the value publicly and have better liquidity, it would be a very good strategy. And that was how we sort of pioneered Blue Harbor. And our approach has been very much a collaborative, friendly approach. In 9 years, we've never sued a company. We've never done a proxy contest. We've never taken a publicly adverse position against our portfolio companies. And this has been, you know, the key driver of our success. We're investing only in those companies that share our passion to create value, that want us as their lead stockholders, and are willing to work with us. Different than Ed's approach, we're less involved in operations. We're looking for companies that are growing, with large sustainable amounts of free cash flow, and there's another fundamental way to unlock value. Maybe we want them to optimize the balance sheet. Maybe we want them to participate in M&A. Maybe we want them to redefine the portfolio of businesses that they own. We think we're going through a deconglomerization of American businesses today. They're worth more in pieces than in the whole. So we love finding those situations where they could do a spin out of a division, or sell a division that doesn't fit, or make an acquisition in a consolidating line. And the final part about Blue Harbor that's sort of special to us is our focus on these $1 to $5 billion companies. We think that's where the best opportunities lie, where the companies themselves don't have the resources to come up with alpha-generating ideas. The typical company we're investing in doesn't have its own corporate development department, doesn't have its own tax department, is not well followed by Wall Street research or banking, and we can come up with real alpha-generating ideas. And certainly M&A has been an important theme of us, and having selected these companies through a private equity lens, some 35% of all the companies we've ever invested in have been acquired. So we think that's sort of a special secret sauce for our approach.
Right. Barry, you've been involved in litigation. You've taken a few board seats. It isn't just the quiet activist. But tell us a little bit about your strategy.
Sure. So, you know, I try to be collaborative too. Mm-hmm. And
sometimes it works, sometimes it doesn't.
Sometimes it works, sometimes it doesn't. You know, the mafia says you have to shoot somebody every once in a while for them to know that you're willing to do it.
Tell us about your latest target then.
Yeah. And so the amazing thing is we've done over 50 of these campaigns in the almost 13 years we've been in business. And only in the first 49, I used to be able to say, I've never gone to a proxy fight, always resolve these things peacefully with the companies. But in the 50th, it didn't work out that way. You know, I always call the CEOs when we own like 4.9% of the company. At 5%, you file 13D, and that you inform the world that you are an activist. And so I always call the company and I say, you know, we own 4.9. We're on our way to becoming your largest shareholder. We'd like to sit down to meet with you. And you know, after the guy like gets up off the floor, they typically cancel all their meetings the next day and they fly in because they want to know
what's your plan?
Yeah, what we want. And you know, and I always tell these guys, look, I'm not looking for credit. You guys should take our ideas, make them your own, and we'll be your biggest advocate. And you know, be the agent of change. Don't be forced to do something. And you know what? For the most part, the CEOs, they get it. They appreciate it. They're not happy that we showed up. I mean, by definition, the reason we're showing up at a company is because they've underperformed. right? So, and you're asking them to do something that is different from what they've been doing, so de facto it's a repudiation of what they've been doing. And so I'm under no illusions. I mean, these people are not happy that we're there, but in the end, you know, and it takes shareholder support to convince them to do whatever you want them to do, but ultimately it's the right thing, and it typically works out for these companies. Another aspect of what we do is I've never wanted to have my fund be an activist-only fund. I find it's just too much pressure. You know, that means you have to populate your portfolio with all activist ideas. I don't know if there's enough good ones. And so I like to be able to just sit back. We have more of an event-driven strategy. And I like to be able to sit back and watch pitch after pitch and only swing at the ones that I think, you know, possess all the attributes that I need to see. So we'll be an activist, you know, when the opportunity is there, but we're not compelled to be an activist all the time.
So Peter, you're a advisor to some of these companies that have been the targets of these guys. So what's your advice when, you know, Barry or Ed or Cliff comes knocking at the door of one of your clients? How come, what advice do you give them about welcoming them in, chatting with them, or do you advise them to go to war?
Well, you know, first of all, I would say that the mentality on the call or the activist interest in a company has changed. In the last 10 years, it's changed just enormously. I mean, I think 10 years ago, when a CEO got a call from an investor who was going to assume sort of an activist role, I think their attitude was, you know, how do we get this guy out of here? I mean, that was really almost the universal view. Now, I think the world has moved toward the shareholder. And I think companies understand they're owned by the shareholder. And when a company goes public, you have both an explicit and an implicit contract you're owned by your shareholders. So I think everybody realizes that. I think you're right, though, Barry. I mean, people, you know, no one's breaking open the champagne when they see that you've called. But I think what we do typically when we come in is the first thing is we just try to level set. I mean, let's assume we get a call from a client that says, listen, I've just been called by Barry, and you know he wants to meet with us, and what do we do? First of all, we always encourage a meeting, always, because you're a shareholder, and so it would be inappropriate not to suggest a meeting. And then at the same time, what we do is, you know, we do this thing called the activist within, which is that we kind of pretend that we're the activist within a company and say, look, here are the 5 things we would do. And we do this, by the way, with companies who have been called, but also with longer term clients who we know well, just to sort of keep them ready. And I think companies generally like that sort of independent view. They may not agree with us, they may not agree with an activist investor, but that's sort of the dialogue that we try to create with our clients.
But I think that makes sense because, you know, they wouldn't come knocking if the company, if everything was going well at the company. And so why can't the companies, why can't they see it themselves? You know, like Cliff and Ed said, what's obviously to Cliff, you look at the balance sheet or you look at some of the issues that Ed discovered, why can't the company do a self-reflection?
Well, I think there are 2 different, when there's disagreement on that, I think there are 2 different reasons for it. One is they just may plain disagree. So if an activist investor comes in and says, you know, split the company up because the businesses have nothing to do with each other, and separately they'll trade more than they do together, just a, you know, sort of a typical thing. The company just may disagree with that. They may feel that there is a way that these businesses can create value together. They may not feel that they will trade better separately. They just may just disagree. So that's one area why there's sometimes disagreement. The other is sometimes these companies know something that an outside investor does not. You know, they know something about the realities of separating a business that they may not want to talk about publicly. And so to the extent that an activist investor remains outside the company, then that just may have to stand. If the investor comes onto the board, then as part of their board responsibility and relationship, they'll kind of learn and understand that. And they still may disagree. Yep. But those are typically the reasons we see where there's not sort of, you know, sort of a simpatico understanding of where the business should go.
And Michelle, let me ask you, as they come knocking at your door to talk to you about trying to persuade you when they're in a proxy fight, BlackRock obviously large holder of so many, oftentimes the largest shareholder. So what message do you look for? What can they tell you that convinces you to vote BlackRock in support of the activist agenda?
Well, basically what we're looking for is an argument focused very much on the best economic interests of long-term shareholders. And that's informed by the history of BlackRock, which is that we have a very significant part of the money that we manage for our clients invested in index strategies, which means that our clients are by default locked-in investors. And so some activist campaigns don't necessarily convince us that this is the right thing for long-term investors. Often with the companies that activists come to talk to us about, we will only have a holding in the index for all the reasons that have been identified. There are either operational or strategic issues at the company. And so the programs or the activists that we tend to support generally couch their arguments in very strategic terms. Often they're looking for our support for getting people on boards, and we generally support the candidates who clearly demonstrate that they have industry expertise to contribute to the functioning of the board. Because our view of corporate governance is not that it's a compliance with a set of standards, but that you are enabling really good leadership at board level and good execution at management level. And I think one of the most powerful things that activists do is they are that market reality check on the companies that, for whatever reason, have lost sight of the shareholder perspective on how the company is being run.
So a board seat. Ed or Cliff or Barry, when do you decide to take a board seat? What triggers that, and when do you stay off? Barry, let's start with you.
I try very hard not to take board seats. And in the vast majority of situations, we haven't taken board seats. You know, if you're on the board, you have limitations on liquidity, and you know, one of the things we prize is the ability to be able to change our mind or liquidate a situation just because the stock price gets to our target price. So we only in rare occasions will we go on the board. You know, for example, I went on the board of a company called Convergys. It's a call center company, and it was an underperforming company in like every metric you know you could think of, and you know, fortunately the board realized that they needed help, and they actually invited me in, and I had developed a nice relationship with the chairman, and I thought because of that I would be able to be more effective, and so I agreed to go on for a limited period of time in order to just, you know, prosecute the changes that I thought were needed. And I ended up having a very productive relationship, very friendly relationship with all the board members. And it's funny, after I got on the board, virtually every single board member at some point or another during, you know, the first couple of board meetings came over to me and said, "We're really glad you're here. You know, we knew this company needed a kick in the ass, and you know, you were the impetus, so thank you." But otherwise, you know, we will oftentimes get an industry expert and have them as our representative on the board. And you know, they're independent, but these are people who have proven over time that, you know, they have better track records and more experience than the existing management teams, and have generated tremendous value for shareholders over time. So they have credibility with the sell side, credibility with the shareholder base, and credibility just with you know, the business community. And so, you know, when hopefully they look at the business the right way, come up with good ideas for, you know, for the business to, you know, to run as effectively as possible, and will be attractive candidates for institutional investors like Michelle.
Good. Cliff?
Yeah, it's something I feel quite strongly about in not going on the boards. I've been on, you know, 15 boards early in my career, and I think that, you know, nobody wants a director for a couple of years, you know, and I think if you make a commitment to a board today, you're really making a long-term commitment. You want the comp committee, you want the audit committee. There's a learning that takes place that requires you to be on the board for more than a couple of years. When we make an investment in a company, we tell the company we're not a private equity fund. If we're sitting around here 4 to 5 years from now waiting for you to unlock the value, which is our thesis, has been a mistake. We underwrite to a very high return, and we want that done in 2 years. And so I think that going on a board, gives you, I see others go on boards and sort of fall in love. You lose your liquidity. You get MNPI. It's hard to get out of these positions. And so it's something that we don't want to do. In our market cap of $1 to $5 billion, we're typically the largest stockholders. We own 5 to 10% of these companies, and we have the CEO's home number. We have the relationship. We can be, we think, as impactful without the board positions. But like Barry, occasionally, if we think the board needs to be strengthened, we'll put a former CEO of one of our portfolio companies or somebody from industry that we know and respect and can be helpful on the board. But from Blue Harbor's standpoint, we don't take the board seats ourselves.
Yeah. Ed, you guys have taken a lot of board seats over the years. It's part of your strategy.
Yeah, we probably go on the board at least half the time. And every investment has its own personality, but probably at least half the time we're going to take the board seat. And I would say when we don't take a board seat, it's a situation where the ease of execution is such that we're confident management and the board are going to get it done, that management genuinely buys into our plan and has passion behind our plan, and they don't really need us. It's a relatively quick fix. And so last year we invested in Intercontinental Hotels, largest hotel chain in the world. Management genuinely bought into what we were saying, and there was no need for us to go on the board. Same thing with Lazard. But in a lot of cases, it's going to take time to get the business turned around. We have duration of capital. Bulk of our capital is locked up for 3 to 8 years. So we're typically going to be in the investment for 3 years. It's going to take time. There's going to be fits and starts. We want to make sure that we're in that boardroom representing all of shareholders to make sure it's getting done right.
Yeah. Let me ask you a question, because a lot of times you all get criticism being short-timers and short-termers. Hedge funds get in, get out, look for a pop in the stock. But what you just said, Ed, you hold 3 to 8 years. Cliff, you had talked about the holding period. Where did that myth come from? Why do people think, you guys jump in, look for a pop in the stock, somebody gets a free rider, they get their...
It's really a myth.
Why?
It's really a myth. I mean, everyone on this panel and the broad activist investors out there are really not looking to get in and get out in a quarter. I mean, there isn't a lot of money in that, and there's no business in that, and you're not really creating value. You're not, delivering sustainable alpha to the stockholders with good ideas. And I think it's a myth. I mean, we're in for 2 to 3 years. Ed's in a little longer. Barry, I think, similarly. And it takes time for a company to understand your idea, analyze it, get a banker involved, and then for the market to recognize the value that you want created. Sometimes we get lucky and our companies get taken over, and in a short term you can't plan for that. But I think that to make substantive and not temporal change and create value for the long term, it takes a couple of years.
Yeah. Barry?
Well, I was going to say, it's also a function of what are you advocating for. And, the changes that I think we all, at least on this panel, advocate for are changes that are for the good and for the long term. They're not just sort of quick fixes. And so I think that is makes a big difference. The management teams that call you short-term are typically management teams that have, under both long-term and short-term time horizons, have underperformed. And so they don't have the merits of their arguments to debate you on. So they say you're short-term, or they come up with all kinds of other things we've been called. And it has nothing to do with the debate that should be taking place, which is what's the best lever to pull for value creation.
Is that a common, do you hear that when some of your clients say this is somebody who just wants to come in short term?
Well, I never think that these discussions are sort of obvious. In other words, it's never that, there's a really, really obvious short-term pop that's going to occur and then hurt the company, or the reverse. I mean, the issues that are really most hotly debated are those which are nuanced, sort of on the margin issues. So, for example, sometimes companies, they might make an investment that's a very significant investment that won't have a short-term payback, and it may or may not have a long-term payback. Now, that's kind of a gutsy move, but that's not so obvious. You know, that's a good debate. You know, whether or not something can happen. I mean, and I'll mention one company that would never be subject of an activist, I don't think, attention.
You may have heard it here first.
But which is Google, and because they have their dual class stock. But the Google made a really gutsy investment into Android, and so they could put forth their mobility platform, and they basically gave it away for free. That was a gutsy move, and I could see there sitting as a shareholder saying, I wouldn't do that necessarily, but they did it, and I think it's benefited the company, and maybe that's an obvious one. But there are lots of these things that are really, really tough judgments to make, and I think that's where the debate really occurs most deliberately.
Yeah, Michelle, when they come in to talk to you, do you talk to them about short-term versus long-term? Because as a big institutional investor, you're like us. We're in it for the long term. We have liabilities that go out 30, 50, 100 years.
Absolutely, and it is the frame within which we try and take our decisions on the proposal being put to us. But I do get really concerned about the argument around short-term versus long-term, as if one is a good shareholder and one is a bad shareholder, because the market necessarily needs shareholders with different perspectives and different commitment time frames. And if everyone were ultimately a locked-in long-term investor, then I think management could quite comfortably get quite complacent. So I think it is important that activists are willing sometimes to rock the boat a little bit. That said, I think the activist firms that we tend to support, and we don't choose firms to support, but whose campaigns at multiple companies over time we have supported, have been the companies that have been the activist firms that tend to prefer private dialogue and who use the proxy fight as a last resort, who have managed to come to some negotiated way forward with management, because oftentimes the least disruptive approach is the best. And I think the point that what you want is change rather than getting credit for having brought about the change. So if management want to lead the change agenda, that's fabulous. One of the things that I would observe, having looked closely at activism over time, both in Europe and here, is that an awful lot of successful activism campaigns involve a change of leadership, either at board level or within the management. And that is often that very defensive stance that companies take, that whatever the activist wants to do is short term, because the individual sees their job on the line.
Yeah. Now, you talked a little bit about activism in Europe because of your experience there. Ed, talk a little bit about some of your experience in other countries. Then I'm going to also call on Barry, who I know recently had that experience.
Well, the UK is a great place to invest with regard to corporate governance. It's very shareholder friendly. There's no separation of chairman and CEO. Sorry, the mandatory separation of chairman and CEO. There's no such concept as a staggered board. You can call a extraordinary general meeting at any moment. So it's very shareholder friendly. And so, our success at Cadbury, where we had a company that was, again, world-class business, fundamentally great business, but where the margins were 1,000 basis points, less than everybody else in confectionery, where we really felt that we had a good plan to get the company performing in line with the likes of Hershey and Wrigley. The ability to call an extraordinary general meeting and get other shareholders involved and probably make wholesale changes at the board level was an important, an important leverage point for us to be able to make good things happen there. And obviously, the company was ultimately acquired by Kraft.
Barry, your experience overseas. We've talked about this before, both in Canada as well as in the Netherlands.
Yeah, we've had generally good success overseas. I mean, we've been an activist successfully in the Netherlands and in Germany and in the UK. And recently, we had a situation in Canada where, it turned out we encountered a management team that, at the end of the day, was more concerned about their ego than what was best for shareholders, and was more concerned about who got credit for the changes. And notwithstanding that they implemented a number of things that we suggested, you know, they couldn't bring themselves to say that we had anything to do with it. And then the company resorted to basically tactics that were so outside the norm of corporate democracy that I mean, I was just stunned. I mean, this is a company that bribed shareholders, paid 25 cents a share to brokers for successful votes. They never disclosed this scheme. We found it out. They changed their proxy, the experience that shareholders, that directors had from one year to the next, just because it fit the rhetoric that they were articulating. They, the whole management team threatened to quit if we put one person on the board, you know, which is a complete violation of selective disclosure, and on and on and on. And amazingly, Canada Inc. rallied around this company. This was not an obvious campaign because this is a company whose stock did well on an absolute basis, but on a relative basis to peers, it far underperformed over many years. And there were a number of reasons for it. But Canada Inc. basically wanted to protect this company. And at the end, when the voting, they also, you know, they cut the voting period short, the notice period short by a month so that they could cut off people buying the stock. And then when the voting was over on a Friday afternoon, we won. And then I woke up Monday morning and found out we lost. And they went and got one of the large institutions in Canada. They threatened them, and then they promised them business and all kinds of things to revoke their vote for us. And so we lost narrowly. So, you know, we certainly were home courted. But ultimately, you know, there's a cost to what they did. There's a cost to corporate governance in Canada. At the end of the day, I mean, will I think twice about going back to Canada? Yeah, I would. And that's not good for shareholders or values of Canadian, you know, stocks. There's a reason why the United States generally trades at the highest multiples in the world because of the favorable corporate governance environment. And also, is this company now under even greater pressure to do the very things that we, you know, were advocating? They are, because the shareholders, you know, came to realize how terrible their actions were. So, you know, it was a learning experience, and I have no regrets about it.
So the tactics you won't use. You know, Cliff, you say you rarely take a board slot. What are some of the tactics or the engagements that you've gone into and you've realized that you've changed your approach? Or Peter, some of your clients in terms of the responses back to some of them. So Ed, let me start with you. In terms of some of the tactics or the fights you won't get into that you've learned through the experience, some of your war stories.
We're trying to develop a constructive relationship with management and the board. Like Barry, we always try to stop at 4.9%, right below the filing threshold, in order to get on the same page with management out of the public spotlight. Our philosophy is to be very clinical in our approach. There's no adjectives, there's no insults. It's not that this acquisition was dumb or this move was stupid. It's very clinical. We look to establish trust with management. We're very proud of the fact that virtually every management team and board that we've worked with, Ann, is a reference for us going forward, which, you know, success begets success, because as we approach new management teams, we tell them to call the CEO of Heinz, call the board at Tiffany, call the board at Family Dollar, speak to the other people that we've worked with, and they generally hear very good things. So, you know, I think it starts with developing a relationship, developing trust, making it clear that you truly understand their business, you understand the nuances and subtleties, you're not going to be bamboozled, that you have a very thoughtful plan, that is not just leverage up the company, split up the company, sell the company. It's a very thorough plan, highly diligenced, incredibly strong work product. And we always say to management that we'd rather be rich than right. So if there's anything flawed in this analysis, willing to listen, you need to have the same attitude. If we're certainly willing to listen, and I think staying out of the public spotlight, developing that relationship, being thoughtful, that's really the recipe for success.
I mean, there's lots of things that we won't do. I mean, we have a really disarming approach. We say to these management teams, if you don't want us as your lead stockholder, if you're not going to unlock the value, if you don't think the company's undervalued, we're not investing. It's very clear. Now I'm telling you how friendly we are and how wonderful we are. I also will admit that no CEO ever went home to his or her significant other after the first meeting with us and said, the most wonderful thing happened today is these guys from Greenwich, Connecticut came to tell me how to unlock value in our company. CEOs have big egos. There's a reason why they've never sold the business we want them to sell, or they don't want to change their balance sheet. But that's where our job starts, and it's about the quality of the conversation. And we come back a second time, we come back a third time, we show them the analysis of how accretive it could be, and why we're willing to put $100 or $200 million behind them. But at the end of the day, if they tell us, look, we don't want you on board, we're not going to unlock the value, we're not going to pursue. And there's nothing wrong with hostile or more aggressive activism. I'm not making a value judgment about that. There are companies out there that are badly run and need to be pushed around more aggressively than Blue Harbour will do, but that's just not our strategy. We've lost money 3 times in 9 years in a stock position, and I think a lot of it has to do that we're only investing in those subset of companies that are going to unlock the value and want us to be their lead stockholder. So we don't sue them, and we're not, and when we have a tough conversation, it's always behind closed doors, and we don't take them on publicly, and we're willing to say we're not going to back them if they're not going to work with us.
Yep. So the growth of activism over the past few years, I mean, a lot of money has flown into your funds, as we know. You've seen the evolution of activism. So Barry, from when you first started, how has it changed from when you first got started? And Peter, from some of your clients also, how have you seen the change of activism?
So 10 years ago, when I would show up in a company, first thing they would do is probably sue me. They would.
Was that your advice, Peter?
They would alert the SEC and the Justice Department. They'd come up with some claim. They put in a staggered board, poison pill. They wouldn't meet with us. They just barred the door. Mutual funds, who I would call, who would be large shareholders, you would think they would be happy to talk to us because we're here to try and unlock value. They wouldn't even return our phone calls. I remember I once had a guy, a mutual fund that I called. This was a company that the CEO was literally a criminal, and he was trying to steal the company from the shareholders. And I called this mutual fund, and he said, I agree with everything you're saying, but if you end up getting the company sold, that means I just have to go find another stock to buy. And
we won't name names in
yeah,
that one.
Right. So, cut to today, it's an entirely different attitude. I mean, as Peter was describing, companies want to talk to us. They want to know what we're about. They want to find common ground. They never sue us. They poison pills have, declined at a precipitous rate, as have staggered boards. I mean, it's a much healthier environment today, and it's gotten a lot easier.
Yep. Peter, how have you seen it change?
Well, I think to Barry's point on poison pills, this is sort of an interesting statistic, which is that poison pills are shareholder rights plans. I think in the S&P 500 10 years ago were 60 to 70% of the companies had them. Now I think it's 8%. And the reason that is because boards really don't feel that it's, in most cases, an appropriate thing to have in the company. So, I mean, that's just a tangible point on how different things are. The other thing that I've found, and part of this is because my old life at one of the big firms and my new life at an independent firm, is that boards often want independent advisors to come in. And so, you know, we talk about management and boards in the same sentence, but really they can be quite separate. And it's not they're not undermining the chief executive or anything else, but there are some situations where boards may want an independent advisor to come in, particularly when an activist investor arrives, to just say, look, on a clean sheet of paper, you guys come in, just tell us what you think. Tell us what you think about this. And in those cases, in some cases, management might have their own advisors, and that's not a bad dynamic, frankly.
Well, it's a good dialogue. You get, you know, sort of a 360, you know, sort of an objective assessment of that. Ed, have you seen that with some of the ones that you've gone into, sort of separating the board from the management? You know, do they have a good premise? Does Trian have a good premise? What's been your experience with that?
Look, I think I think everyone's saying exactly what reality is, which is boards today increasingly want to hear new ideas. You know, it's so different than it was a decade ago, where boards were more likely to resist, no matter what the historical performance of the company had been. You know, we just announced that we've invested $2.7 billion in a couple of very large cap food stocks. Pepsi put out an announcement that they're working with Trian very constructively, expect to have more meetings with us to work through what our proposals are. And that's the kind of, you know, reception you're getting today. You know, think about Pepsi. It's an incredible business, 100 billion market cap company that, you know, willing to listen, willing to think about new ideas, and that's really the environment we're in today.
Yeah.
I think there's been a sea change really since the financial crisis. I think that most corporate directors realized that the root cause of the financial crisis itself was poor corporate oversight of Fannie Mae and Freddie Mac and AIG and a lot of the banks and investment banks. I think directors are very wary to be seen to do the right thing, to be responsive. This isn't universal, but this is pretty much out there. I think that the days of the board made up of the CEO's buddy from the golf club and the guy who owns a local bank in town is really over. And I think that a lot of the large state pension plans led by Ann, and who's really been a thought leader at CalSTRS, have sort of gone to Washington, gotten the rules changed on broker voting and proxy access, and are facing off against companies directly with shares that they own directly. And I think generally there's an understanding in the boardroom that the stockholders own the company and matter. And this is hugely important for activist investors, whether they be the collaborative type or more aggressive type. You know, if you've got a good idea to unlock value, you do need the board to listen to you. And I think, you know, there's obviously more improvements that need to be made, but I really think we're on a paradigm shift, and we're not going to go back to a world of stockholders don't matter, no transparency, you know, insular boards. And that's really something of the past, and I think that's really important for the opportunity set for activist investors, because if you have a good idea, you need to make sure you have the audience. And I think boards generally are a lot more responsive than they've ever been.
Yep.
You know, Cliff, I think Cliff is spot on. After WorldCom and Enron, boards became much more engaged and very focused on disclosure and the integrity of the financials. And I think we're part of a movement where boards getting more involved, shareholders getting more in now operational governance and making sure that the businesses are actually performing.
Yeah. Michelle, you wanted to say
Yeah,
something.
I was going to say
And
that
I want to
from-
ask you, under what circumstances would BlackRock call one of these guys and say, maybe you shouldn't get involved with us?
that we would tip them off on when we thought they should do it. I think that's probably going to be a long way off yet. But, I mean, one of the things I was going to say that I think is also changing on this landscape is that the mainstream investors like BlackRock, like Vanguard, State Street, and others, Capital and so on, are taking on a little more of an activist mantle themselves. So they're not going to be 13D filers, probably. But because of, in many ways, because of the path made by the activists and the greater awareness of boards of their accountability to shareholders, there is much greater dialogue now about strategic issues from the shareholder perspective with board members and also with management, where it's much more of a listening type meeting where the company is listening and the shareholders are talking, rather than the normal sort of investor relations meeting where you'll sit and be broadcast at by a company. I think one of the most significant points of progress in this country is the introduction of majority voting. Because if shareholders can't remove directors in a relatively straightforward way, then why should they feel accountable to shareholders? Because then it's the chairman or the chief executive who removes directors unless there is a major activism campaign. And I think that has subtly shifted the balance as well, and there's much more focus of how many votes in favor I got at the shareholder meeting.
Well, I think there could, and you're right, I think majority vote is changing, and as most companies or hopefully most companies are going to majority vote, the shareholders, now if we could get all of them, get a little more proxy access capability, we're still fighting that battle. But through the efforts of folks like yourself in terms of getting changes on the board or getting the management's attention, we're all benefiting from that, I would say. So then the question is, we've seen sort of where we come from, so what's the future of activism then? Where do you see the landscape going forward in terms of 5 or 10 years? Barry, why don't you kick that one off?
Look, I just think shareholders are going to have a greater and greater voice, and I think that's positive. I think that a lot of the efforts that you and Michelle and others have put forth, have changed the landscape and have made management, rather boards, more accountable. And I don't think this genie is going to be put back in the bottle. So I'm very bullish on what we do.
So, Peter, as an advisor, where do you see this? Do you see the same way the genie can't put back in the bottle?
Yeah, I just think it's the continuing pendulum of capitalism. I mean, I think it's a very natural evolution. I mean, I think back to the point on U.S. versus outside of the U.S., we see less activism outside of the U.S. and the U.K. Wow. Mm-hmm. And I think that will certainly catch up. And the emerging markets is a whole different situation, and we're not really involved in that many situations in those markets that would be akin to this conversation. But I do think that it will continue, and I think boards will increase their sensitivity, and it will particularly increase outside of the U.S. and the U.K.
Yeah, no, I think you're right. You're beginning to see some activism in some other markets, but it's sort of in the very infancy stage, I would say, other than outside of the U.S. or Western Europe in some regards. We are going to leave some time for questions, so there is a microphone in the aisle there. If anyone has questions, yeah, go ahead, sir. Mm-hmm.
Hi, Michael D. I'm based in Asia, and I have to say activism is A, non-existent, and B, quite necessary. But there are two questions that I wanted to ask Michelle and Ann first. Do you think that when you look at these situations across the board, has activism really added alpha over the long haul, over the long perspective? And then I wanted to ask the investors, the activist investors, when you look at corporate governance today, what are the 2 or 3 things that really need to change in order to make boards more accountable and governance more productive?
Okay, let's take question 2 first. What 2 or 3 things need to change, and then Michelle and I can talk about the other one. So, Ed?
Look, I think the world's moving in the right direction, where shareholders increasingly are galvanizing behind activist shareholders to give them the leverage with the board and the management to make the changes that are necessary to create value. And I think you're going to see that trend accelerate.
Yeah. Cliff?
I would like to see a separation of the chairman and CEO role in companies. I think that's a really good governance.
Us too.
I would like to see continued alignment on compensation to make sure that management is rewarded for creating stockholder value. I think that's very important, and certainly one of the lenses we look through in selecting a company is to make sure that management is properly incented and is going to win only if we win. I think that's important. And then when I wanted to make one other comment about your question about the future of activism, I think it's all about the returns. As long as there's alpha in this strategy, and I believe there is going to be significant alpha and has been in this strategy, because you can help companies, do things to create value, then there'll be capital behind these managers continue to grow, and you know, that I think the returns is like the most important part of it, and I think it is a high return strategy, and I think there's alpha available, and that's what all of us here are trying to do, and that's the most important part of it.
Well, and last year, you know, the activist investors outperformed the S&P, so I think for the past couple of years it has been good, and I think you're right, the capital will flow there. Barry, what couple of things would you say?
I focus my answer is solely on the shareholders. I think at the end of the day, that's where you derive the most influence, is if you have shareholder support. And so I think, you know, what has to continue to evolve is long-only investors have to care more. And there's still, you know, BlackRock is unique, and there's a few other long-only funds that you know, think as entrepreneurs like they do and have the, you know, kind of an open mind. But there's still a lot of people stuck in the, you know, in the 50s and 60s. Yeah. And, you know, and that's what management relies upon. And until you can get these people to start being open-minded about change, you know, you're going to be limited based upon what the shareholder complexion looks like in a particular company.
And from where I sit at CalSTRS, I agree with you, because, you know, I can call Michelle if we have an issue or a proposal up and sit and talk about the merits of it. Some of them I'll call and it's like, well, we vote with management all the time, and you know, send us the stuff, and it's like, oh my gosh. You wanted to say something on some of the things that needed to change.
One of the things I think that's really challenging right now is getting directors who really deeply understand these businesses, and particularly in the bigger, more complex institutions. So, you know, if you're a director of one of the big mega financial institutions, I mean, that's really, really difficult. And, you know, it's hard for them in their defense to come in and spend, you know, go to 6 meetings a year for a couple days and be in a position where they can really opine with confidence and nuance on a strategic move. And so, you know, I don't know quite what the right answer is, but somehow maybe it's limiting number of director spots or for an individual, or it's, you know, sort of guiding more significant engagement into a company. I mean, I think that's really, really important, because when we're sitting around a boardroom talking, I mean, you know, some directors are just really, really deeply into it, and I frankly think very helpful. And others, they're not, because it's just very difficult for them to, if they haven't spent the time, it's very difficult for them to contribute as their fiduciary obligation, you know, frankly requires.
Yeah, and we spend a lot of time, I know Michelle does too, in terms of the directors, and, you know, how do you get fresh directors in the boardroom when it's time for somebody to go after 15, 20 years? How do you get the right talent in the boardroom? Because we depend on them. Let me briefly, from the CalSTRS, and then I'll turn over to Michelle, perspective in terms of, you know, does it pay off in the long run? Because we do have activist managers, some of whom are sitting up here, and others, and we're going to be in this stock, when they may exit their position. And so we do measure what the longer term performance, and go back and sort of quantify that they have done better for us, and that what's sitting in our index fund for 10, 20 years. And so we do benefit from that, and we do measure that in terms of our managers.
Yeah.
Michelle, how the long term?
A couple of observations I would make, and at the risk of offending my fellow panelists, I wonder if there isn't going to be downward pressure on fees for all kinds of specialist funds, just as part of a general trend, and whether that will impact the economics of these activism funds. And particularly because it's an incredibly resource-intensive way of investing. So I'm not saying the fees aren't justified, but there is downward pressure on fees across the board. The other thing I would say, just in terms of evolution and governance reform, and it's sort of taking up a point that Barry made, one of the things that struck me when I moved to the US from Europe is how little shareholder collaboration there is, and this idea of not calling back activists, you know, is because people are not well informed about what the rules are, or they run scared of the rules, or they use that as an excuse not to
or the company tells
pull back.
To be scared of the rules.
Oh yeah,
yes.
Exactly. And I think the litigious nature of the environment here does sort of support that very defensive approach. But unless shareholders collaborate, then you're doing a lot of repeat work or doubling up on work. And I think that's a really unfortunate thing, given that we're all a bit resource constrained.
Yep. Yes, sir. And then Go ahead.
My question? Okay. Yeah, first off, my name's Steve Miller. I'm the independent chairman of the board of AIG. And in response to Peter's remark about the job only requiring 6 visits a year, I wish that were true. It's a lot more intense than that. My question is, and it starts with the preamble that I have high respect for what you as activist investors do, and your ability to get access to the board is a very constructive part of our whole system. But there are others who seek access who don't have your objective of creating shareholder value, but have narrow parochial interests, whether it's save the whales or getting involved in the labor relations of the union and so on, of the company. And how do you separate out better access for what you do from perhaps the distracting access from single issue shareholders?
Special interest. Who'd like to take that one? Michelle?
In the
I'll
spotlight.
call on you. You get visited, I'm sure, or get the,
Well, we do.
the
I
special
mean,
interest as we do.
because of the fact that we're invested so broadly, we get approached by those same types of shareholders seeking to influence our thinking on those special interest issues. And from our perspective, mostly what people want is to be heard. And I think if the board can set up a means by which you can let those people feel heard, but not necessarily using director's time. So having a really very good and effective corporate secretary who has that as part of their role to be a communication channel into the board, I think that can be really beneficial. Because one of the things that I think companies get wrong in these situations is they think that the only communication channel is outwards, which is a sort of, loosely speaking, generalizing the traditional approach to investor relations. If you establish a clear channel in and people feel that they've been heard, I think you take the sting out of a lot of those campaigns.
Yeah, I guess the other thing that I would say from my perspective at CalSTRS, because, I'm like Michelle, I get them all and, hear from them all in terms of the special interest and is it, an issue. I guess when it comes down to is when we talked about shareholder democracy, I sort of have faith in the shareholders to determine, is it a real issue that's going to add value and, add to the bottom line of the company, or is it a special interest issue that is sort of out there? And if it goes to a vote of the shareholders, a lot of times you see they barely, they don't even hit the double digits on some of those. Now, can it be a distraction and take a lot of time and they play out in the media? Yes, and it is tough, and, we've been on both sides of that one. But I think communicating with them, understanding what the message is, and then if it ultimately goes to the vote of the shareholders, a lot of times they can't get the support. So, yes, sir. Mm-hmm. Yeah.
Do mutual funds have the experience to be activist investors or engaged investors?
One thing I would say, I have some private equity friends in the audience, so I'll throw a bit of a grenade at them, which is these long-only mutual funds. There's been this notion forever that there's certain behavior and actions that are appropriate as a private company, but not okay as a public company. And I think increasingly that thinking is outdated. And so I'll reference Dell. I think rightfully a lot of the public shareholders are scratching their head why Michael Dell can create value as a private company but can't do it as a public company. And he had to write in the proxy exactly what he plans to do to create value, invest in the sales force, train salespeople better, invest in the emerging markets. He's going to use the capital structure aggressively. He's going to use the cash in the balance sheet and take on $14 billion more of debt. And shareholders are saying, why can't we do that as a public company? And this whole notion that there's somehow acceptable behavior as a private company, that you somehow can't pull those same levers as a public company, completely being challenged. And a lot of what we all do is engage in a dialogue and a debate about how hard can we pull some of those levers. Look at Heinz. Warren Buffett is leveraging Heinz 8.5 times through the preferred. Oh, by the way, cash preferred. If one of us suggested that we lever Heinz 8.5 times, would be vilified. But this debate about what's appropriate to create value in the public markets versus the private markets is going to continue, and it's all part of the institutional investors getting more involved in the future of the businesses.
Did you want to add anything to that, Michelle, in terms of the? Okay. We are about out of time, so I want to thank the panelists for their contributions and thank the audience for attending for the questions. Thank you.